So a warm welcome to everybody on behalf of Trinity Business School and the Centre for Social Innovation. My name is Martha O'Hagan. I am Assistant Professor of Finance in the Business School, and this is the second event of the Trinity Business Ethics Speaker Series. We are delighted to have Professor Dirk Schoenmaker with us this evening. And just briefly before I introduce our speaker, just to let you know the format of this webinar. So first of all, Professor will give us a presentation, we would welcome that if you use the Q&A functionality rather than the chat function, please post questions at any time during the presentation, and after the presentation there will be a further opportunity to ask questions. So we would welcome your input and questions. Following this, we will wrap up the webinar within the hour, but it will be followed, as other speaker series have been, by a social event. So we'll take a 5-minute break at the end and then rejoin after 5 minutes for an informal social event if you'd like to join with tea, coffee or a glass of wine. So our speaker is Professor Schoenmaker. He's a Professor of Banking and Finance at the Rotterdam School of Management in Erasmus University. He's also Director of the Erasmus Platform for Sustainable Value Creation. He is a non-resident fellow at the Brussels-based think tank Bruegel and a research fellow at the Centre for European Policy Research. His research covers the fields of sustainable finance, central banking, financial supervision and European banking. He is the co-author of Principles of Sustainable Finance and also of Financial Markets and Institutions, a European Perspective. And he's the author of Governance of International Banking, the Financial Trilemma. His PhD is in economics from the London School of Economics. Before joining Rotterdam School of Management, Professor Schoenmaker was Dean of the Duisenberg School of Finance between 2009 and 2015. Prior to that, between 1998 and 2008, he served at the Netherlands Ministry of Finance. And in the 1990s, he served at the Bank of England. As well as this, he's a regular consultant for the IMF, the OECD, and the European Commission. So it's rare to find someone with such extensive experience of academia, of government, and of central banking. So we are truly delighted to have Dirk Schoenmaker with us this evening. So I know many students from my module have joined us this evening, and I was just chatting before this, saying that I was looking for a suitable textbook for a while for sustainable finance. I felt I couldn't continue to teach finance as usual. We had to transition towards the future of finance, and so Professor Schoenmaker really does provide us with a way forward and a new way of conducting sustainable finance. So I'm going to hand over at this point and look forward to the Q&A afterwards.
Thank you, Martha, for the really nice introduction. And I wish I could be there because I've been a few times at Trinity. And I know your lovely buildings. At Erasmus, we are really a recent university. We just had a 100-year celebration. And I think you have many more centuries. So next time I will visit you again. So you're lucky with a really beautiful campus. And the challenge is really a change in thinking. And we were chatting also with Daniel before. It's about ethics. We talk about morality. And what finance people tend to do is to think in risk-return relationships. And in the end, it all boils down to risk and what does it cost us and do we have less financial return? That I would say is one perspective. But if we think about finance, the origin of finance and of economics was about allocation. Which investment projects are we going to do? Which companies are we going to finance? And then once you switch your perspective from risk return to allocation, then you can start to look for opportunities. So how can I contribute to solving the Sustainable Development Goals. We will do that today, but a prerequisite is to get out of this old risk-return thinking and to move to allocation. And just to pay tribute to Trinity College, one of your previous professors, Phil Lane, he's now at the European Central Bank. And I had a discussion with him and his staff on monetary policy. Should monetary policy take sustainability into account? And all these economists cannot think any further than, well, if credit risk is not good aligned to carbon risk, we should recalibrate the risk assessment for haircuts, for collateral, the technical terms. But in the end, if you do monetary policy, if you do, you buy corporate bonds as part of the quantitative easing, are you buying bonds of Shell or are you buying bonds of a renewable company? That's an allocation. And people find it very difficult to admit to that is the real issue. It's about allocation and what kind of decisions you take. And if you take that perspective, then it becomes fun, because then finance people, you and me, we can become part of the solution. We can finance the future. We can stop financing tobacco and other things which are not good for the future. So I encourage you as students and also colleagues, staff and others to really think about the origin of finance, about allocation. And then I get started now. Check. Okay, I think you can see it now. So, sustainable investing and transition. So the second thing, apart from allocation, I want to do today with you is to get transition thinking in your head. Okay, let's get started. So the first question is why? Then in the end, we all know it's not about investors or the bankers, but it's about the real world, the corporates. Can they move from financial to integrated value? I'll explain it in a minute. Can the financial sector take a broader approach beyond financial thinking? And then finally, we can do a lot of talking, and I'm good at talking, but in the end, we need to do it. So what are the tools? And that's important. Okay. This book is really different from normal books, because if you say we have a finance book, you would start with finance. On purpose, we start with sustainability. What are the big challenges? And then it is about the companies in the real world who try to reach out to the sustainability challenges. And then finally, finance comes in its allocation role, how they can help out, contribute to these companies who wants to be sustainable and move away from the unsustainable companies. And then finally, a bit about transition. And the key message is, we don't find sustainability in the financial metrics. So if we keep on just maximizing financial value, we miss out on biodiversity loss, on carbon emissions, and on social issues in the supply chain, like child labor and all kinds of human rights violations. You won't find them in the financial metrics. So you need social value and environmental value to add on to your financial value and then integrate them in integrated value. That's the big challenge, what we are going to do today. So some of you may be familiar, but for those who are not, let's start with a bit of hard science. And that's great that you are at a business school and not a bigger university. Sustainability is really about integrating disciplines. And what the Planetary Boundaries Framework is saying is, from green to yellow, you're already getting into danger, and in red, you are in a high risk. With climate change, we are fastly entering the red area. We are still yellow. With biodiversity loss, we are already there. I'm in the Netherlands. We have a big agriculture crisis because there's too much nitrogen, that's at the bottom, phosphorus on the land because of our intensive agriculture. And now we have to reform our core business. You know, the Netherlands is about farming. We have to reform our farming business because they have too much nitrogen. So these boundaries are real world ecological challenges. You see land system change, that's of course about deforestation. Fresh water use is here still green. And in your country, in my country, we have enough water. But if you go to Cape Town a few years ago, if you go to the Middle East, to Iran, there's a huge shortage of fresh water. That is getting an increasingly big constraint. The next thing is, at the social front, remember sustainability is both ecological and social. This is from Kate Rayward from the UK. Food security, adequate income, access to health care, water, clean cooking facilities. I remember many of these countries, they still use wood to cook. Education, decent work, meaning in the supply chain we pay a living wage, gender equality, social equality, and political voice. So many people live below these foundations. And we have translated all these elements of ecology and social into the Sustainable Development Goals, and you probably have seen them. At Erasmus, we started off with picking the favorite one. My favorite one is life on land. I think we really need to restore land, which helps also climate change. But all 17 are extremely important. And we were just chatting before we started. If you take number 16, peace, justice, and strong institutions, in the Netherlands, the court has already commissioned Shell to reduce emissions. The court, up till the highest appeal court, so up to the Supreme Court, has ordered the Dutch state to live up to the signature of the Paris Agreement. And now, yesterday it was announced that the second coal-powered station in the Netherlands will be closed by the government because they got the order from the judge to be Paris aligned. So don't underestimate the power of law in this case as well. And it's interesting to see that all disciplines are joining in. So it's not only about carbon tax, there is more to get there. Now my marketing starts, because I have to move you and myself slowly to finance. So they call this the wedding cake. So at the bottom, we have the biosphere, the environment, what we call E. Then we have society. Society lives within the environment. S and the economy, although we all think the economy is the most important because we are doing business or economics. In reality, economics is nothing more than organizing your society in an efficient way. But without society or without a livable planet, there is no economy at all. And this wedding cake shows that while we always look at the top, the wedding couple, the foundations are important of a good wedding cake. How to play around with these three factors, that's what I'm going to do. That's what we do in the book. So if we go to old-fashioned finance, the finance as usual, we call it shareholder value, and especially your neighbors on the West, the US, they're quite good at it. They just look at F. The shareholder are the owners of the company. Well, they are only owners of the shares, but they feel like owners of the company. And they take first. So if there is any profit, we use it on share buybacks, on dividends, and not on increasing pay to the staff or to other things. Then we get refined shareholder value. People are getting smart. If we don't treat our employees nicely, if we don't follow a bit the basic environmental rules, our employees, our customers may walk away. So we do it in an instrumental way to do the bare essential. The stakeholder value is, okay, we recognize we have shareholders, but we also have other stakeholders, like our employees, local communities, bigger society, the environment. We need to serve them all. And the third one, that is a really small minority. They put impact first, S&E, and finance is only a precondition. So you need to have some kind of return to stay alive, but impact is your first goal. But that's a small minority. So the big question is how to get majority of companies, investors, banks from sustainable finance 1.0 to 2.0. That's the big challenge. And just to show, if you only, so this is what you will see if you take the real value, the integrated value of the company. At tobacco, we all know it. Profit, huge amount of employment, but we also have the extra cost of healthcare and premature death. If you add them up, you don't have to be a business economist to do that. We all know net negative. But why can they continue? We only see the profit part in the financial accounts. And as long as the profit comes in and the shareholders get their profit, they're happy. But I don't know about Ireland, our healthcare pension fund, they started off divesting tobacco a few years ago. Last year, ABP, that is my pension fund, that's for civil servants and education. They started to divest tobacco and they're getting divested more and more, and the cost of capital is going up for them. But this is really the financial system. As long as you only look at the financials, you would not detect what's happening on the left. But then the big question is, this is all nice, and some of you would say, okay, but that's why we have a government. Yeah, we get legislation, we get high taxes on cigarettes, we should have a carbon tax. So why would the private sector, whether you are at the bank or at the corporate, why would we care? And if you think about it, you can have many different reasons. And what I really, and put them in the chat and in the Q&A, and what I would like to stress is that there are multiple reasons. You may want to anticipate regulation, your company is already ready. Reputation, pressure from NGOs, the Greenpeace and Oxfam, Amnesty International, if you have breaches of labor rights, like what's happening a lot in China nowadays. Consumers, you may want to future-proof your business, and we will talk about transition in a minute. But the final one, and then I come in the area of my colleague Daniel, who's teaching out in Dublin, your moral responsibility. And let me share my own experience. I didn't have this number 4 on my slides before. Then I got questioned by a good friend, a lawyer. He said, Dirk, why was it missing? And then a student in Italy, a law student, asked me the same question. And the important thing is what you think as a private person at home. Please keep on thinking that when you go to school or when you go to business. don't make a separation between your private personality and your business personality, because that's where things are going wrong. If you really believe that people should be treated properly, then also if you're an investor or you're working in a company and you decide on a supply chain where you source your materials, you should also pay attention that you treat people properly. So the disconnect is when we think that as a business person we should act differently than as a private person. So bring your private morals to your work, also as a student. That would be my important message. Once we start doing that, then things are more natural, and don't think that your colleagues don't want to do it, because that is a big mistake, that we all think, okay, I want to do the good thing, but the company does not allow it, or my colleagues. In practice, that's less often than you think. So bring your personal views into your study, into your work later on. It helps a lot, and it gives more peace of mind. Okay, now a bit of fun. After all the moral talking, transition thinking. So this slide is no surprise to you. So the big transitions are underway. In the Netherlands, the energy transition. Last year, we had the first time, we are the countries of the windmills. We had a windmill park at the North Sea without subsidy. It means that windmill is now equal cost as fossil fuels. And as economies of scale are improving, the windmill will decrease further. The same with solar energy, maybe not in Ireland and the Netherlands where we have a lot of clouds during the year, but in the hotter areas, solar panels, the cost is really dropping by the day. So it's happening. It's only the speed is an open question, but it's happening. Raw materials is a new one coming up. We cannot keeping, we need to think circular, so reuse the raw materials rather than each time new ones. That's the second one, circular economy. And the third one, for those who are interested, read the Dasgupta review earlier this year. And healthy food, regenerative agriculture, that's really on its way. And the biodiversity trend is equally important as the climate trend. And they are hand in hand, because climate is one of the driving factors of biodiversity loss. Because if the climate is changing, then the habitat is going down and animal species lose out. Finally, we should not forget about the social transition, decent labor practices in the value chain. If we source out our clothing, our fashion to Vietnam, we should really pay care that labor conditions are safe and that a proper living wage is paid. These four trends are happening. And the big question is, for investors, but also for bankers, if I give a loan to a company, if I do equity or bonds in a company, is my company prepared for the transition? Yes or no? That's the big question. Let me make it concrete. So this is the only formula you're getting today, but so expected transition losses is your exposure at transition times the probability the transition is happening, and then 1 minus A, and A is for adaptability. So if you can adapt, you can reduce your losses. If you cannot adapt, so your A is 0, then the full amount is at loss. So let me go step by step. So the exposure at transition is B times V, and B is how big is the transition in your sector? Is it a small part or the full sector. I will give an example in a minute. Then the value of the company is at risk. So if the transition is halfway, then half of the value of the company can be lost. Then how likely is it to happen? And then finally, is your company adapted, prepared for transition? Then you get a 1. And if you're not prepared for transition, you get a 0. And just to give you a nice example, Kodak, you all know it, they were sticking to paper-based photography, so paper-based photos. So they didn't adapt, so the adaptability was 0. When digital photos came in, they lost out. So if you fill in an A is 0 in the formula, and the full sector is in transition, you can see what happens. The whole value of the company will be lost. Okay. I'm now going to do this to a real-life example, which you will all recognize. You all know Elon Musk. And so I go to the car market. On the horizontal axis, you see the timeline from 2010 to 2030. We are now halfway, 2021. And on the vertical axis, you see the shift in the sector. And in this case, the shift from combustion engine cars, so the petrol and diesel cars, to electric cars. So 2010, there was rarely one electric car. They're now slowly moving in. In the Netherlands, I think we are at 5 or 10%. And by 2030, we expect no combustion engine cars to be sold anymore. So Tesla is clearly on this curve. They are capturing the market. If you are doing business as usual, the BOW scenario, at some point, and certainly by 2030, there is no market left for you. 100% of the market is electric cars, and nobody's buying your car anymore. And I don't have to tell you what happens to the value of your company. So the B, the transition of that particular sector, is 1. And now we are going to plug Volkswagen in. So one assessment, and you are living next to the country, and we also of John Maynard Keynes. And one of the famous sayings of Keynes, he had many, is better be approximately right than precisely wrong. And in this case, the 0.4 is just an approximate assessment. So let's say Volkswagen is at 0.4. So they can do a bit of electric vehicles. They have now this ID 2, 3, and 4. That's the new model, the new electric model. So they're capturing a bit of the market, but they are way behind. Of course, the labor force is engine electric engineers and not software engineers. So for an electric car, you just have software engineers. So they are in a real reshuffle of the company. The CEO has a big fight with the trade unions because he wants to fire the engine engineers and to hire the software engineers. And it's a question whether they can catch up or not. So they're now at 1.4. And let's just show you the value implication. So if this is correct, what does it mean? Well, fill in the formula. The B is 1, and the whole sector will be transitioning in 20 years. Then we get the value of Volkswagen. And the probability of transition, I think this one is now safe to say, will be 1. There is no way back. Volkswagen is at 0.4. So that means that 0.6 of the share of the value of Volkswagen is at risk. If you think about it, 60% of the company value, just not equity or debt, but just the total value of the company, 60% is at risk because they are too slow in the transition. So my message here is adaptability or transition preparedness is a key factor in company valuation. So I'm just going back to the slide. If your company is in the building sector, still working with concrete and only steel, and is completely missing out on the circular trend. Circular building means working with wood. Then at some point the company may lose its customers. If you are an intensive farmer in the Netherlands or in Ireland, you don't move to organic or biological farming, you may in 10 years time lose out. So the trick is, if you're a business analyst, where are my companies? Are they aware and working on a transition, even if they are not there today? Or are they closing their eyes and living in the past and doing business as usual? That's the big question, with value implications. Remember, 60% of Volkswagen's value is at risk. Okay. But then how to do it? So that are nice words. So the first one is, as investors, we need to include sustainability in our analysis. That's now HLEG, means High Level Expert Group for the European Commission. Luckily, you're still, like the Netherlands, part of the EU. European Commission is quite big on sustainable finance, and fiduciary duty means the duty of the investors to their clients, means that they have not only to take care of the financial side, but also they have to include sustainability. But then, how do we pick sustainable investments? Let me do that to bureaucrats, and I've been one myself, so I can say it. So we make a taxonomy about green, gray, and brown products. But now we get arm twisting. So France wants to have nuclear in the green, and then to get a majority, they get Poland and others in on gas. So now your sustainable investment coming from Brussels will be gas or nuclear energy. Well, I'm not sure that's the way we want to go, but anyway, civil servants, I've been one myself, you are behind the market and you get political negotiations. I think as an investor, as a banker, you should do your own research. Fundamental investing is what we call it. And all of you who have followed the course of Marta know how to do it. It's not difficult to do. Okay. But what we need for fundamental investing is that we start to think a bit differently. So we aim for long-term value creation. We think about the adaptive market hypothesis rather than just efficient markets, the integrated value. And let me just move on. So number one is, don't rely on ESG ratings. They are worse than credit ratings. And you remember the financial crisis, all these mortgages with ESG, with high AAA ratings. They're add-ons. They don't address the core issues, a lot of design limitations, and large companies can report better, so they get higher ESG ratings. So you fail to spot the real problems. So we really need to move on, and I'm just skipping this one and just showing what we need to do. So all of you who have done the finance course know efficient markets. All the information gets straight into the share price, and adaptive markets hypothesis saying depends on the number of and the quality of the market participants. And well, you make up your own mind, but I think the second one is more plausible. And the good news is the number of analysts who look at sustainability is increasing. So the markets are getting better, but we are not yet there. Second, we need to move from these ratings to really fundamental ESG analysis. So you really need to check how sustainable your company is by just looking into the company, doing a cash flow analysis. And then we have big pension funds, your pension funds, and my colleagues in finance, and I did it in the past, you need to invest in the market portfolio. That means you invest in thousands of securities. But then you cannot engage with companies because there are too many. If you look empirically, after 1, 200, 300 companies, the benefits from diversification, that means less standard deviation, are gone. So with 300 shares, you can have a fully diversified portfolio. You don't need the full market. Then you have a smaller portfolio, and then you can start what we call engagement to talk to the companies. And then, so you've studied, let me just show you so you do your analysis of the companies. The good ones are the ones you can improve, so they are willing to improve. You select them in a concentrated portfolio, you engage with them, and then the engagement you use again in the feedback cycle to increase your share in the company or decrease the share. This is, I call it the virtuous cycle of sustainable investing. But it means you need to analyze your companies. You don't talk about equities anymore, but you talk about investee companies, real life. That's where you can find the information. So finishing off, first of all, we need to expand our thinking from financial to social and environmental, and to integrate these 3 value dimensions. And second, once we start transition thinking, and we say, okay, Volkswagen is on its way, maybe another company is behind, then we move to Tesla, Volkswagen, and then we can speed up the transition by financing the ones who are at the forefront or the ones who want to improve. And then I'm going to stop my slides, and I'm looking forward to the
Great, thank you. Sorry, Dirk, thank you so much for a really fascinating presentation, and interspersed as well with really good examples that really bring to life what you're discussing. So I'd invite all attendees to type any questions that you have into the Q&A. And while people are typing, I might kick things off with a question of my own. And I guess it's something that I've tasked the students with for a project, which is, so one of the things that you recommend in your book is more like private equity investing, that you do a deep dive into the company and that you're more engaged with the managers of the company, which is more possible with private equity investing. But of course, one of the problems with private equity investing in reality is that it's really only available to large investors. So for individuals, I suppose most people, their larger saving is for their pension. What would you recommend that as an investment strategy, to question your pension fund, or, very few B Corps are listed, but the FT was reporting just last week that one has been listed on the London Stock Exchange, or ESG ratings. Do you have, practical advice for anyone on the call as an investor?
Yeah, I can give a nice one which really applies to you, your colleagues, but also to the students. In the Netherlands, we have already for years going on complaints about ABP. ABP is, the biggest pension, one of the biggest pension funds in Europe, civil servants and education. So my pension fund, for academics, but even students, they started to protest. So they really went to the offices of ABP, and they at the door, and they were blocking the doors. So they were really getting angry and protesting. The ABP was a bit caught offside, Of course, they were thinking about responsible investing. They are in the Netherlands, so they are worldwide on the forefront. But still, on this one, they were caught offside. Now, I think they went a bit too fast. So what they did is they just announced in October to divest all oil companies. So the supply of fossil fuels, they will divest. And the users, so the high, the carbon intensive companies, the users, they will now engage closely with, check whether they have good strategies to decarbonize. If not, they will divest. And the pressure from the students and from the academics really put them to that decision. Without that pressure, it would not have happened. That's a change in society. I mean, that's a societal license to operate. In the Netherlands, and let's not put everything on Shell the same as for BP and Exxon. They may still have their legal license to operate, but they are losing the social license to operate. Half of Rotterdam School of Management students don't want to work there anymore. They're losing legal cases now. Then they are divesting in the US and they're just giving all the money back to the shareholders. Well, they could have given half to the shareholders and half in renewable energy. They are not doing it. So pressure works. Question your pension fund.
Great. So more activism, student activism. Bring
Yeah.
Great. I have a few questions in the Q&A. Mary Lee Rhodes, one of my great colleagues, is asking, what do you see as the main challenges for investment firms wanting to use this analysis for assessing investment opportunities?
Yeah, the step one is that you say goodbye to portfolio theory. So the capital asset pricing model and what we learn to students, and that you have to invest in the whole market portfolio, and that your benchmark is the market index, and if you deviate from the market index, then the whole world is down. In my book, I have the example of Alecta, a Swedish large pension fund. They have only 100 shares, 100 companies in their portfolio. They have their own analysts, their own investors. They follow the companies. They do the deep dive on these 100 companies. They talk to them. They appoint directors. And then it works. So just dare to do it and forget about the market index. And that's extremely difficult, because if you start to work in asset industry, only thing people talk about is, did we outperform the benchmark or not? That's the only thing they can think about. And that's not what is relevant. The relevant thing is, do I have a return for my pensioners? That's relevant. So absolute return. And can I have positive impact? So forget about the old-fashioned finance.
Excellent. Yeah, we say we need to retrain, and part of the business school's responsibility is to differently, and for future asset managers to think differently.
And to add on to that, dare to do it. So when I first did the book, I had a class. I had the draft chapters in my class, and the exercise, which is now with the book and you also did with the students, is with scenario analysis. I had a scenario guy helping me out, and he did it for free. And then we gave the student several companies with cash flows, and then they had to make the scenarios. And it was a huge success. Well, we wouldn't know at all whether it would work, whether the students would be able to do it. So experiment, dare to do it. There are no failures, and just get going. You need to believe. That's important.
Brilliant. We have another question from Samra Azkagil, saying thanking you for the presentation, but asking about information asymmetry, which of course is there in many forms. And the question asks, what do you suggest to institutions providing information such as FTSE and Domini?
I don't know these institutions, but the problem is we have all a behavioral bias to be too optimistic. That's human nature, and it's also a nice future often. And in addition, companies always show the good news in an annual report and not the bad news. So it starts off, and that's your job, Marta, my job, to educate students, critical people. Don't take it on the blue eyes, but read secondary sources, read what the NGOs are talking about the company. So look for secondary sources. Still information about companies. For example, we try to do Inditex, that's Zara, the clothing company, and fashion. There are huge problems with cotton, which is not environmentally friendly, in the labor, in the value chain, child labor in Vietnam. You don't find it in the annual report. The good news again is the Corporate Sustainable Reporting Directive is coming in 2023, and maybe 1 year delayed 2024. They require companies to show environmental social impact, and the auditor needs to check it, whether it is complete. So yes, there is a huge asymmetric information, but get going and look at secondary sources. Look what Amnesty International is saying about the company. Hey, we all know about Apple. Apple had this huge problem that all the iPhones were made with child labor and other problems. Look at the sources of NGOs. I'm not saying that they are right, so the company may not be right, but look at different sources, then make up your mind. But that's a big problem, asymmetric information.
Great. There's lots of questions. I'm just going to come in with one other question that, just given your history of working in central banking, the role of central banks and regulators, the BIS, for example, capital requirements, central banks and QE. Do you have thoughts on that?
Yeah, I'm just drafting a paper on it, and what we call it, from market to green economics, and what are the consequences for the European Central Bank. And the ECB was founded in the 1980s, 90s. And you all know, you've lived through it, Thatcher, Reagan, so markets were solving everything. And the government took a step back, and I saw one of the questions, yes, we need the government for carbon tax and others. Even if the government will be doing it, as private actors, finance people also need to do it. So yes, we need the government, but they cannot do it on their own. But the 1990s meant the markets can solve everything, so we only need the central bank to set the interest rate independently, and that's it. In the financial crisis, we learned that financial markets are not self-equilibrating, so they can be out of equilibrium for a long time. So now the central bank is allowed to do financial stability and supervision. And I don't have to tell you, because you had your housing crisis and then your banking crisis, and I studied your country. That's why I visited a few times for the IMF. And I think you recovered greatly, but you know exactly what can go wrong in this belief in markets. Now, I showed you the picture of planetary boundaries. If you take that serious, that's a Das Gupta review. People are really interested to read that. That's a great economist from the UK. That means we have an ecological constraint. So in our economic models, we should model in that the carbon budget, so the amount of carbon emission, is reducing. But biodiversity loss, so more soya oil or palm oil, soy and palm oil from Indonesia and Brazil with deforestation, is not acceptable. Once we start to put that in our economic equations, we get a completely different way of doing the economy. And so we need green economics, ecological economics. And the central bank is, in its monetary policy, trying to steer the economy. And I'm stimulating them, and that's this allocation, because everybody understands risk. So that for financial stability reasons and supervision, we move away from, we call it stranded assets, that we move away from oil companies. That's what we all understand. That's logical. That's consensus. But on the allocational role as monetary policy, I would encourage really to take the ecological economics, the ecological constraints serious, and to redo your allocation. Take away from things which are business outside planetary boundaries is not sustainable in the long term. It's so easy as that.
Great. We have 6 questions on limited time, Dirk. So I'm not sure if I'm going to read a few and maybe you can choose which to answer. There's a question about your views on the value of the 6 capitals model used by the International Integrated Reporting Council. There's another about regenerative capitalism outlined by John Thornton.
Yeah.
Yeah, if you want to
I can
jump
take
in.
these two. I can take these
Yeah.
two. So the 6 capitals is exactly what I'm doing. So natural capital is environmental value, social and human capital is social value, financial and manufactured capital is financial value, and intellectual capital applies to all 3. So I'm a big fan of Integrated Reporting Council, and we slice the cake a little bit different, but the underlying ideas are exactly the same. So I'm a big fan. Similarly, John Fullerton, former, I think it was JP Morgan, but former investment banker, got converted, and like all of us, and at least me as well. And he's great. We were even thinking of trying to get him to the Netherlands. So his regenerative capitalism is exactly saying what I said. We should operate within the ecological regenerative boundaries of the planet. Because the alternative is, if we say the government should do it all, we have the state planning. We all know the history of state planning, communism. Sometimes it turns out all right, sometimes wrong. And let's try to use the decentralized principle, but in a responsible, regenerative way. I think that's the big challenge, because Tesla, electric car, was not invented by a government, but by markets. The vaccine is not created by people, by civil servants, but by people in the market who saw a business opportunity. So let's move capitalism into a responsible way. Then we are in business.
Great. And we have a further question on the urgent need for governments to address the negative externalities of poor ESG, including the use of penalties and tariffs. So I think you've spoken to that a little bit, but I'm just going to group questions in the interest of time. The next question asks about the investment integration project founded by Steve Lindenberg and Bill Burkhart for getting rid of portfolio theory and moving to incorporate systematic impacts on investments. Do you have any thoughts? I'm sure you strongly agree with those thoughts. So I might just group those together if you don't mind.
Yeah. So to start on the externalities, and remember I have these 5 reasons why we moved to 4 reasons, and one of them was anticipation of regulation and taxation. And the honest answer is, if you have to do it because of Brussels or because of a tax, that helps a lot in the implementation. So government action or the threat of government action is extremely helpful, and like the airlines, it is so extremely important that the kerosene tax, kerosene will become part of the ETS, the European Emission Trading System, and is no longer exempt. That's extremely important. So there is a big role for government, but don't wait for it, is my message. And I'm a big believer in complementarity. So the governments do their thing, but business and finance can do at the same time. And we as educators, we all move together rather than waiting for each other. I think that's the big message. SDGs are for everybody, not just for governments.
Great, thank you. I might just ask one more. There is a question there which is quite long by Raman, but I'm just going to. There is the social event afterwards for further questions as well. Yeah. Josephine Matthews is asking your view on Future Fit Business Benchmark as an investor framework baselining planetary boundaries across asset portfolio. She's just wondering for your views on that, and she's a follow-up question which has its origins in the same academic circles as planetary boundaries.
And is that the question also on the board, or is it a different one? I see the one on the...
The last two on the board.
Yeah, because if I can take the one on the board, I'm now working on corporate finance. And yes, we should not tell people what to do because we are all grown-ups. You're grown-up, I am. We don't like to be told, especially professionals don't like it. But we need to create conditions. And what is the big challenge? People of my age or older, if you're unlucky, all male, typically on boards. Well, that's not the way to get companies to move to the new world. So diversity is extremely important. And get the stakeholders on the board. So some people are suggestion, why don't you put somebody from an NGO not in your board? And try to put young people in the board. How can you put the future? The environment is all about the future because we will survive. But how would you put the idea of future carbon emissions? Then that's the big challenge, how to put future generations, their interest in board decision making. What are really interesting questions also for the academics who are listening in, whether you are from a legal or from an economic perspective working corporate governance. That is the big question of the time, how to get the boards the design differently, that they act by themselves responsibly rather than regulation is not going to do the job. We need to move intrinsically to better decision making.
Brilliant. I'm going to try to keep to time. And so we've only 2 minutes left of this session, but just to remind you again that we do have a social event after this. So we'll take a break once in a few minutes, and we'll take a 5-minute break and come back. And I think Dirk is able to join us for 10 more minutes, which would be fantastic. But I just want to say a huge thank you for a really fascinating talk. And I feel like the amount of questions that came in, I think really speaks to how important the topic is and how engaged people are with the topic. So before I wrap up, before the social event, I've also been asked, I'd just like to mention the next speaker series, the next speaker in the speaker series, which will be on the 20th of January, and that's Julie Batalana. The topic is Power for All, how it really works and why it's everybody's business. So registration for that will open from tomorrow. So yeah, without further ado, Dirk, thanks a million again. I'm going to turn off my camera and mic for 5 minutes. And just a reminder, if you do want to join the social session, you just need to accept, you're going to be sent a message, do you want to rejoin as a panelist? And you just need to say yes to that. And then you'll be able to unmute in that.